Well, I'll give you an update on AGNC, which is a mortgage REIT that I own, that I've been introducing to you over the last month or so. They had earnings this past week, and beyond their bottom line numbers, which we knew was going to show a loss because they would have had fair value losses on their holdings. When we look at just the operating earnings, they did beat by a penny what the expectations were. At the top of the screen, I have some analyst ratings, and the red line is post-earnings, and this was pre-earnings. April 29th, just before earnings, 4 companies had released a rating on AGNC. Barclays, $14 with an overweight. UBS, 13, neutral. JP Morgan, 16.50, the highest one out there, with an overweight. And RBC, 15 with an overweight. Post-earnings, Nomura and Credit Suisse, both at 14. One with a buy rating, one with a neutral rating. All of these are very much in line with their tangible book value per share, which is about $13.60, $13.70. We had that as of March 31st. And I said that that would be an attractor price for a company like this because their assets are primarily financial assets listed at fair market value, which means that the purchase of the entire company should be its net tangible book value per share. And so it should trade in around that price. Right now it's trading at a discount, and I don't see it trading at a premium for a while. I think it'll continue to trade at a discount. I had owned 3,000 shares of AGNC going into earnings. After earnings, I like to get confirmation of something. So if I have a thesis that something is good and I buy something, I don't really buy more ahead of earnings. I wait for earnings to confirm my belief. And if earnings are good and it confirms it, I'm willing to add more at that time because I feel that I'm buying a better company with better information, or I'm better informed at that time. So I bought another 3,000. So I am long this particular stock. I think it'll hug very closely to its tangible book value per share, which is $13.60. I don't see it making big moves above $13.60, and I don't see it selling at too much of a discount to $13.60 unless there's another major dislocation in the mortgage REIT market. So I was selling $11 puts, and I had sold some May $11 puts after the earnings announcement. I'd decided that I'm going to sell puts a little bit higher, so I'll draw the line here at $12. I am now selling $12 puts because I don't mind the stock being put to me at $12. I sold 20 at 70 cents, and I sold another 20 later in the day at 90 cents. So I have a total of 40 at an average price of 80 cents, which means if they're put to me, my average cost is $11.20. Which is, I think, 15 to 20% below its tangible book value per share. I'm comfortable owning it at that price. 12 cents a dividend per month. That's $1.44 a year, plus what I'm making by selling the puts. And if I do get more put to me, I'm fine. I would not mind having a position in agency over the next year as high as 30,000, 40,000 shares. I would be comfortable with that. I'm okay with that. I'll be selling the $14 calls, but I'm going to let the market tell me when I'm going to sell the $14 calls. I will not sell them until I see agency make a run upwards. So on any rally into the mid-13s, if I see agency get to $13.40, $13.50, the $14 premiums, I'm looking for at least 60 cents. I'd like to get at least 60 cents on the $14 premiums, then I'd be selling them. So I'd be looking to sell the June 14s on any move into the $13 range. So if the market shows me any strength, or if this company shows me any strength, and I get participation into that mid-13 range, then I will sell the 14s. I have 6,000 shares, so I'll be looking to sell 60 contracts. I would sell them all. I would have them all called away from me because they'd be called away from me at a premium. That's fine. Being that the tangible book value per share is an attractor price, if they're selling at a premium, at some point they will go into a discount. I'll pick up more there, or I'll sell more puts to put myself in a position to buy them at a discount. But I don't see them trading above premium or at a premium price for quite some time, so I'm more than willing to sell those $14 calls. And for May, I have puts that I think aren't going to be put to me because they'd have to get below $11 before May. And if they do, I'm good with that. The Junes, I have 40. I don't mind if they get put to me. I really don't. Based on the strength I saw on Friday and what they've reported, and with some of the target prices out here, I don't know that I'd get much of an organic opportunity to get them below 12. By organic, I mean by their own weight. The market may bring it there for me, but I don't see AGNC itself bringing the price there for me. So tying this back to the content, by owning the underlying and selling the calls, that's called a covered call position. We use it for income generation when we believe that the underlying is not going to get above the call strike price. I set the call strike price above the tangible net value or book value per share price, so that if it is called away, it's called away at a premium. And combined with that, I'm selling puts, cash secured puts, which can be used for one of two things: generate extra income on a monthly basis, or add to my position over time, which I am willing to do. That's the idea behind the cash secured put, is that if it is put to you, you must have been willing to want to own it anyways. What am I owning? I'm owning an income generating stock, which again fits into my type of profile of the types of things that I like to earn. And I'm generating an income off this from four possible sources. Source number one is the dividend. Source number two is the income from the covered call. Source number three is the income from the puts. And if they are put to me, well, then I have more of the underlying, of which then I earn a dividend on. And source number four is potential capital gain within that band that I hold. If I see that AGNC is drifting up over time, I would change these bands. I would move my puts up to 12.50 and then 13 over time, and I would move my covered calls from 14 to 14.50 up to 15. I would move with the stock over time. But now I have an asset that I own that I can find multiple ways to generate revenue from on a monthly basis.